What's up, income investors? Adrian here, and welcome to my channel on passive income investing. In this video, I will unveil my entire updated dividend stock portfolio, which many of you have been asking for. So about 5 months ago, in early April, I released a video which went over my portfolio in detail. I went through all the stocks, actually one by one, all 120 of them. So let me tell you that a lot has happened since then. I learned a lot in the last few months thanks to the COVID-19 stock market crash. And although my portfolio did take some damage, I'm very grateful it happened this early in my investing journey. Keep in mind that although my wife and I are already financially independent in our mid-30s, we are nowhere near done investing. So these lessons will serve us well in the future, and I'm happy that we could share them with you, our growing audience and followers. So all the positive comments, thank yous, and suggestions we received give us the motivation to continue sharing our knowledge and our progress. So just a few points I want to cover before I unveil my portfolio, which will be available for download for free as usual. I will basically try to anticipate some of the questions you're gonna have here regarding my portfolio, so I'll get those out of the way now. If you don't care about hearing these points, that's fine, not a problem. You could just skip to the portfolio unveiling, but I'll just try to keep it very brief. Alright, so point number one, this is our main portfolio and main source of income to pay off all our living expenses. So the portfolio is definitely income focused and not growth focused. So like the name of our YouTube channel, we are definitely income investors. This simply means that the goal of our fund is to generate consistent and relatively high income via dividends. This portfolio does not include our retirement accounts, which are completely separate. I did make a separate video on my RRSP account, by the way, if ever you want to check it out. So our retirement accounts have the DRIP turned on, or the dividend reinvestment plan, which means that the dividends are automatically reinvested in buying more shares of the corresponding funds. So that is where our growth, if you will, is being taken care of. By the time we're in our mid-60s, those two accounts combined are projected to be worth about $1.5 to $2 million. So that's definitely enough growth for us, thanks to a magical thing called compounding interest, which Albert Einstein was a huge admirer of. Point number two, I will be showing you the portfolio in a spreadsheet and not on our online broker account. The reason is pretty simple. Our portfolio is spread out between 4 accounts: Erica's TFSA and cash accounts, and my TFSA and cash account. So when I say cash account, by the way, I simply mean it's a regular non-registered account. So showing you in the spreadsheet is the only way for you to see basically the whole picture. Final point number 3, our investment philosophy. So our investment strategy and portfolio has changed quite a bit in the last few months. Like I mentioned earlier, when I first released my portfolio, I had about 120 stocks, many of which were individual businesses. However, as of now, I currently own only 70 stocks. So I would definitely say that I cleaned house in the last couple of months and sold off a lot of individual companies. The COVID crash basically made me realize how risky owning individual businesses can be, even if they have a dividend. So almost all of the dividend cuts or full-on dividend suspensions came from these individual stocks. So I basically went on a selling spree, unfortunately taking some capital losses along the way, but well worth it in my opinion. Since I'm an income investor, dividend suspension or dividend cuts are the worst thing to happen for me, since the stock no longer provides a source of income or a reduced source of income. So I did reallocate, of course, all the proceeds to other stocks and funds, mostly ETFs and other funds, since they were very cheap. So I made up a lot of the lost monthly income already. Needless to say, going forward, I will be primarily investing in ETFs and funds because they are simply safer and more consistent than individual companies. Also, due to their rising popularity, there's definitely no shortage of great choices out there, especially ETFs, which are really hot right now. So now it's time to check out the portfolio. So here is my master spreadsheet, guys, that I created where I track everything. I apologize if it's a bit small and you can't see properly. If that's the case, I suggest you download the file first so you could follow along. Also, once I explain the spreadsheet, I'll zoom in so you could see it better once I go into the stock. So on the left hand side here, this is where I track my income per year. So I simply track my capital gains and my dividends for that corresponding year, which it gives me my total profit for the year. So as you could see in 2020 here, it's the first time ever that I had any capital losses. That is due to the big cleanup that I did in the last few months, which I spoke about earlier. So $23,000 might seem like a lot of money, but on my total portfolio, which is about $630,000, it's something like 3.5%, so it's not a big deal. Also, I made up the money lost already in dividends, so overall I'll still be in the green for the year. This column here, you have the name of the stock and the fund manager if applicable. In this column, you have the stock symbol, which are links, they're hyperlinks to the home page of each company or fund. Pretty handy if you want to do more research on that particular stock. Here you have the stock details, where I like to basically describe what sector and region that particular stock focuses on, along with other relevant information. You have the inception date, which is simply when the fund was created, the annual management fee if it is an ETF or a fund. Investment is the total amount of money that I invested in the stock. So this is my book value. The weight is the actual percentage weight that particular stock has in my portfolio. Shares is how many shares that I own. Share price is the average share price I currently booked on that stock. So it's very important that if you buy more shares of a particular stock you already own, that you update this figure, because it's used to calculate the yield. The dividend yield is simply the annual dividend divided by the share price. The payout is the dividend payout, so M for monthly and Q for quarterly or every 3 months. The annual dividend is absolutely key here. So this is the annual dividend amount per share. So you can see that there's some colors here, which I'll explain in a little bit. The annual income is the annual dividend times the number of shares. This is how much money you will make with this stock in a given year. And the monthly income is simply the annual income divided by 12. All right, so if you scroll all the way at the bottom here, you could see the totals on the right hand side. You have the income totals by year, and you also have them by month. Now, because some of the stocks I own give their dividend in US dollars, I had to make a separate calculation for them because I always want my total to be based in Canadian dollars. So my grand total in Canadian dollars is simply the Canadian income plus the US income times the exchange rate, which I have now at $1.31. So if you actually look at the Excel formula up here, you could see it. It's S79, which is the Canadian number, plus S80, which is the US number, times 1.31. So this will give you an accurate total here in Canadian dollars. So my total right now is $56,351, which translates to an approximate monthly income of $46.95 a month. Right, so back at the top you have the grand totals here. So this is where I calculate the grand totals for my capital gains and dividends and my total profits, as well as the total amount of money I have invested. So as you can see, just under 630,000, as well as my average dividend yield, which is a little under 9%, which is really good. You also have the stock type breakdown, so you could see the income funds, how much percentage of my portfolio does it make up, and how much percentage of my income, as well as the other asset classes I have. So ETFs, split share funds, REITs, and single stocks or individual businesses. So going back now to my annual dividend column, I do have some colors here. So blue is where the dividend will fluctuate. So it's important you keep this updated. So certain funds and ETFs don't have a set dividend, they change every month or every quarter. So it's important you keep these up to date. Luckily, my broker TD web broker is pretty good, so I just copy paste the annual dividends in here. For the orange and the dark green ones here, those are for my split share corporations. So orange just means that I have missed some dividends. So this is where I put the details of how many months have I missed, and overall how many dividends has the split share fund missed in its entire existence. If it's dark green, it means that I personally have not missed any dividends whatsoever. So going down here, the light red here is dividend reduction. So I put the date and the percentage and just a little comment why. You could see here COVID-19. So I did get a lot of a couple of dividend reductions which I recorded. The green ones are dividend increases. There's a few, and if it's dark red and it's 0, it means that the dividend has been suspended or cut completely for now. So let's start with the closed-end funds or the mutual fund corporations. I simply refer to them as my income fund. So the first one is the Canoe EIT Income Fund. This is actually my favorite income stock of all time. It's definitely my flagship income fund. I've owned it for years now and not one dividend miss or cut. It's a pretty big fund. It's over $1 billion in market cap and has been around for a really long time. As you can see, 1997. I absolutely love the fund manager, Rob Taylor. I like his investment approach, which is called the bottom-up approach or the bottom-up style. A very standard investment approach when it comes to dividend-paying stocks. You have a really nice mix here between Canada and the US, as well as your diversification across a lot of sectors. So I highly recommend this stock and checking out the website so you could read up on it more yourself. Mint is the next one, Mint Income Fund. This is the flagship income fund for the Middlefield Asset Management Company, a company I really like. They're experts in real estate. So this fund is also very solid. It's primarily focused on real estate and utility, so very stable and defensive sectors of the market. The next two are from Brookfield, who are experts in infrastructure and real estate. The first one focuses on infrastructure stocks, which are basically utilities. So things like electricity, toll roads, pipelines, water treatment plants, etc. So essential services, I would say, pretty boring but stable and defensive once again. The second one from Brookfield, Select Opportunities Income Fund, is really interesting. If you look at the enormous dividend yield on this one, 17.49%. I think it's a little higher right now because the stock price is a bit lower than what I had it at. The cool thing about this one is that it focuses on infrastructure, a little bit of real estate, but 80% of the fund is corporate debt or corporate bonds, which is considered fixed income. How they manage to sustain such a high dividend for so long, I don't know, but I've been waiting for 2 years expecting a dividend reduction and it never came. So good for me, I guess. So DS and Inc.UN are very unique funds by Quadravest, a firm who specializes in split share corporations. They actually have 13 funds in total, and these two are the only ones that are not split share funds. So they both use a covered call strategy to enhance the yield. And the interesting about these funds is their dividend policy. I think it's really smart. So the dividend varies every month and is set at 10% of the fund's NAV or net asset value. So for example, if the fund's NAV is $5 for a particular month, the dividend rate, which is the annual rate, will be 50 cents a share. So divide 50 cents by 12 and you will get your dividend amount for the month. So this basically means that when the NAV increases, so does your dividend, but the opposite is also true. I like them a lot because the dividends tend to be high, and no matter what, unlike split share funds, you're guaranteed to get a dividend every month. So DS has 15 Canadian dividend stocks, well diversified in terms of sector. Inc.UN focuses exclusively on the financial sector in North America. So a really good way to get good diversification within the financial sector as a whole, because you have banks, life insurance companies, asset management companies as well. So a nice mix there. HGI.UN is a small fund from Harvest that focuses on utilities and telecom companies worldwide. That's why I like this fund. It has great global exposure, and of course, utilities and telecom are very safe and defensive sectors. The Manulife floating rate senior loan fund is pure high yield corporate debt or corporate bonds. So this one is always amazes me because of the high dividend yield that they managed to give. It's paid the exact same dividend for years and years, which is great. It's pretty much the only pure fixed income fund that I own, really because of the nice dividend. So the last one is a recent one. I invested in the Cornerstone Strategic Value Fund. So as you could see from the yield, 16.81, it's really lucrative. What I like about it is that they set the annual dividend way in advance, so you know what dividend you'll be getting for the entire year. The only thing is that they tend to lower the dividend every year because it does not generate enough income to pay out the dividend. So we'll see how it goes. It's been around since 1987, the oldest fund that I have. So obviously these guys know what they're doing. So this fund invests in a huge variety of stocks in different sectors globally, but mostly in the US. This is one of the few US listed, not TSX listed stocks that I own. So of course the dividend is paid out in US currency, which is automatically converted to Canadian dollars for me. Also, don't forget that there's a 15% withholding tax that's automatically taken to pay off the IRS. Hence, I removed 15% from the dividend yield and annual income to ensure I captured the correct data or the correct income that I'm getting from this fund. So that 15% tax, by the way, has to be paid out for any dividend you get from a US listed stock, since we're Canadian. Still worth it, in my opinion. Alright, so moving on to ETFs now. Almost all of them use the covered call strategy, something I talk a lot about in my channel. I absolutely love this strategy since it helps to boost the dividend yield with zero risk. So the first 7 are from BMO, who I would say have the best region-based covered call ETFs that give a very nice consistent monthly dividend. The next 4 are from CI First Asset, which is an ETF provider owned by CI Financial, a pretty big asset manager here in Canada. They have amazing sector-based ETFs. The dividend is nice and high, but the only downside, if you want to even call it a downside, is that they provide their dividend quarterly and not monthly. In addition, the dividend will vary quarter to quarter. So FLI is the top life goals in North America, life insurance companies. KIC, I get the exposure to the big 6 Canadian banks. TXF for technology exposure, and NXF for energy exposure, and there's no Canadian energy companies in that one. So HMMJ from Horizons ETFs is where I get my cannabis exposure. I strongly believe that this is a great growth opportunity right now, and since no cannabis companies give a dividend, I invest in this ETF since it manages to deliver a really nice 9 to 10% dividend. If you want to find out more on this particular fund, check out the video I made specifically for this fund, where I go into detail on how they support such a great dividend and what kind of cannabis companies are included in this ETF. So the next 2 after that are from Harvest, who is another great covered call ETF provider. So the first one focuses on global energy, the second one on global healthcare. IDR from Middlefield is by far, in my opinion, the best ETF when it comes to REITs or real estate. It has a solid dividend, and what I really like about this one is that you have Canadian, US, and a little bit of international exposure, so you're well diversified. Also, it focuses a lot more on the safer real estate sectors, industrial and residential. Those are safer compared to the office and retail space, for example. And the last 3 ETFs are the other US listed stocks that I own. So I own 4 in total. They're from a really good company called Global X, which is owned by Mirae Asset Financial Group, an asset management company based in South Korea, believe it or not. They also own Horizons ETFs, by the way. So they have a few really good funds specifically designed for income. I invested in 3 of them so far. I strongly suggest their website. It's really nice, and you can see all their funds there. So QYLD and RYLD are both covered call ETFs with nice high dividends of about 10% plus. So QYLD tracks the a NASDAQ 100 index, which means it invests in mostly tech stocks since they make up a huge piece of the NASDAQ 100. But you also have stocks like Tesla and PayPal in there. So a really great way to get income and exposure to the biggest companies on the NASDAQ, which most of them are technology. RYLD has the same concept, except it tracks the Russell 2000 index, which measures small cap or smaller companies in the US. So a nice way to get exposure to lesser known, smaller companies in the US here. Phenomenal ETFs in my opinion. Huge income because of those covered calls, very safe and consistent as well. Just check out the dividend history if you don't believe me. They have not missed dividends at all in the last couple of years. But finally, the last ETF that I own is also from Global X. It's a very interesting one because it doesn't invest in stocks or bonds. It invests in the alternatives asset class. So in case you didn't know, there's really 4 asset classes. There's equity, which means stocks. There's fixed income, which are bonds and debt or preferred shares. There's cash equivalents, which are just cash savings accounts. But then there's the alternatives asset class, and that includes real estate, private equity, MLPs, which are master limited partnerships, etc. So I thought it was a pretty cool idea, and recently invested in this one. More diversification can't hurt, right? So these 3 ETFs, like the CLM fund, give their dividend in US dollars, and since they are US listed, don't forget a 15% tax is taken off the top. Okay, so now my split share corporation funds. These are my biggest money makers. I won't spend too much time here because I made 2 recent videos which discuss split share funds in detail and which ones are my top 5 of all time. So make sure to check it out. Needless to say, they're a really good alternative if you want high income. They all use the covered call strategy, and they also use leverage. So that's why you're getting these massive yields. Once again, check out those 2 videos if you want to know more about split share corporations and which ones I like the best. So you have them here. DFN, FTN, XTD are all from Quadravest. The next ones are from Brompton. You have LBS, SBC, GDV. From Midfield, you have ENS, a really cool one because it focuses only on Enbridge, and then I have one from Stratbridge, which focuses on the big 6 Canadian banks. Okay, so now on to my individual REITs. I absolutely love real estate. REITs make up a big part of my portfolio. So since I don't own any physical property, this makes complete sense for me. I asked myself, why own property and have all the headaches involved with that when you could just invest in REITs? So investors who buy physical real estate sometimes, in my opinion, underestimate how much work and time it takes to actually manage an income property. So one thing, however, I will say about owning individual REITs, they are definitely not immune to dividend reduction. So owning individual REITs is like owning individual stocks or individual businesses to a certain extent. They could sometimes reduce the dividend as well as raise it, and as we'll see shortly, suspend it altogether. All right, so the first 6 are my small cap REITs, so they're smaller in terms of market cap. Pro and B2B have recently reduced their dividend by 29%. Not bad. They're still giving good dividends, really cheap right now, so I'm still making a little over 7%, which is good. Melcor REIT and Morguard are my worst performers, I would say. Melcor focuses on commercial properties in Western Canada. They have a lot of office and retail, and Morguard has a lot of retail. They own a lot of malls, which is why they took a pretty big beating. So both of those cut their dividend almost in half. That's why I'm making a bit less in income. My top performing small cap REITs are definitely Nexus and Firm Capital Property. So Nexus, what I really like about them is that they focus heavily on industrial real estate, which is very, very hot and safe right now. Also Firm Capital, really good. They're mostly commercial, but they're focusing more and more on residential, which is good, and they have a nice track record of increasing the dividend, which is great. So those 2 are definitely my favorite small cap REITs. Right, so the next four are my big REITs. So you have Smart Centers, Ryokan, H&R, and Brookfield Property Partners. So these guys all mostly focus on commercial and also have a bit of residential. So H&R REIT is the only one that cut their dividend recently because of COVID. I was a bit surprised. They cut it in half to 69 cents. That's why I'm only making 4.32%. Ryokan and Smart Centers, as well as Brookfield, all holding strong, no dividend cuts or reductions and no plans for any. So Ryokan, especially Ryokan, I saw a lot of YouTubers making videos about this one where they're arguing that's a really good stock to buy right now. I would completely agree 100%. It's really cheap right now. I think it's giving a yield of about 9%, which is a good pickup. Brookfield Property Partners is by far my biggest REIT. They're over $10 billion of market cap. They have a lot of good commercial real estate, prime real estate, mostly in the US. They're the only REIT that I have that gives their dividend quarterly, but it's a really solid one. The next three are my office REITs. So you have Slate Office, True North Commercial, and Innovalis REIT. So Slate and True North focuses on Canada, Innovalis focuses in Europe, specifically France and Germany. So office REITs have also taken a beating because of the COVID-19, more people working from home. But in my opinion, there was an exaggerated sell-off. So it's a really prime opportunity to pick up some office REITs. I'm actually planning on making a video just on undervalued REITs soon, so be sure to check that out. But really good REITs here, no dividend cuts whatsoever recently because of COVID-19. Slate Grocery REIT is very interesting. It was one of my picks of the month last month. So it focuses on, yes, retail, but it focuses on grocery anchored real estate. So grocery stores. So they're essential services, not like other businesses that were forced to close down. So they're performing really well and have a massive dividend yield. I actually invested some more. It's the REIT that I have the most money in individually, so I feel really strongly about this one. American Hotel Income, not so lucky. Obviously, they own hotels in America and the US, and many of them had to shut down because of the travel ban because of COVID. So these guys had to suspend their dividend completely. Very unfortunate. The only REIT ever that I've seen that had to suspend the dividend or cut it completely. But the recent news is that they actually started opening up their hotels and their cash flow positive now. So I'm expecting them to restart the dividend sometime by end of year. Okay, so now my individual businesses. This is where I definitely cut back and sold a lot of them. Many of them had their dividend reduced or cut completely. So I made a huge cleanup. I sold off not only underperformers who eliminated their dividend, but also a lot of redundant companies that are already included in many of the funds that I already own. For example, companies like Bell, TELUS, CIBC, Scotiabank, Enbridge. So if you're Canadian, you know these companies very, very well. These are all great companies to own individually, but since many of them make up a big percentage of the ETFs or funds that I already own, I rather own the funds, mostly because the dividend is much higher due to the covered call strategies and for safety as well. Don't forget, my portfolio is designed to maximize passive income. So unfortunately, this is also where a lot of my capital losses came from this year, but I don't mind at all because my portfolio is much safer now and is much better equipped to deal with future stock market crashes. So I'll go through them very quickly here. All right, so the first three are my restaurant income funds. Obviously, they're doing horrible right now, like all restaurants out there because of COVID. So Boston Pizza and SIR Royalty have both suspended their dividends, and the Keg surprisingly managed to keep a small dividend even though they completely shut down their restaurants during COVID, but they reduced it a lot. I'm a little worried about SIR as they are a smaller company, but I have no doubt Boston Pizza will eventually reinstate the dividend and the Keg will gradually increase it back to normal. Just gonna have to wait it out. The next four are the individual energy companies that I own, and to be honest, I made a vow never to invest in a single energy company ever again. Too volatile, extremely volatile, especially the oil and gas producers. The midstream companies are the ones that manage the pipelines and the infrastructure, are a bit safer, but I rather honestly just invest in an energy ETF like NXF or HPF. They're much better and much safer. Laurentian Bank is a small bank based out of Montreal where I live. Everything was going great. They kept increasing their dividend, but all of a sudden they cut it by 40% recently. It was in the news, so a pretty big disappointment. As you can see, I'm only making about 3.6% on it, but better than nothing. They recently announced a really good quarter at least, so I'm cautiously optimistic. Power Corporation is pretty solid. They own Investors Group and Great West Lifeco, so they're a huge asset management company here in Canada, and they have a good history of increasing the dividend. Atrium is the only MIC that I own, or a mortgage investment corporation. Pretty stable and no complaints here. Solid 6.5 dividend. One thing to note about MICs is that the income you get is usually classified as interest income and not dividend income, so it's actually taxed more. Automotive Finco is a very small company on the TSX Venture. I kind of took a chance on this one last year, and boy, it's paying off. These guys provide financing for people who want to buy car dealerships. Apparently, there's a lot of action and consolidation in this space, so they are capitalizing on that. You could read all about it in their investor presentation on their website. Pretty interesting stuff. No dividend cut whatsoever, a great 12% dividend, but I definitely consider this one higher risk. I wouldn't put more in it, more than 5,000 in it personally. Chesswood, also a specialty finance company. They provide financing to small to medium-sized businesses for commercial equipment. So big disappointment as they cut their dividend in half when COVID started, but 1 month later they simply suspended it altogether. So I'm confident they will reinstate it eventually. I think they did it with an abundance of caution, but we're just gonna have to wait it out. The stock price is slowly recovering as well, so I'm not too worried about this one. Alaris Royalty and Diversified Royalty, I really like these guys. They're very similar companies, so they basically partner up and provide financing to smaller but well-established private businesses in exchange for royalty payments, hence the royalty in their name. In turn, they distribute those royalties to us, the shareholders. So any company with a royalty in its name where the fundamental purpose is to give dividends to the shareholders always gets my attention. Alaris actually recently changed their structure and became an income fund, hence the stock symbol is now AD.UN, and they also changed the name of their company. Decisive Dividend, the bane of my existence right now. This is a small cap company on the TSX Venture that simply buys out small and well-established manufacturing companies in Canada and distributes the profits to shareholders in the form of dividends, hence the name of the company. It turns out though that Dividend isn't so decisive as they suspended it completely at the start of COVID. I personally don't understand why, as none of the 5 companies they own had to shut down. The reason was an abundance of caution, and they say they will reinstate the dividend when appropriate, so I'm eagerly waiting. I even emailed the CEO a few months ago with the brilliant idea to change the name of the company to Tentative Dividend. He never replied back though. Exchange Income, I'm a huge fan of. They have the exact same concept of Decisive Dividend, where they simply buy out manufacturing companies and distribute the profits to us with dividends. They focus on the aerospace industry, and surprisingly, they did not have to reduce their dividend even with the COVID wreaking havoc on the aerospace and aviation industry. Simply amazing. They also have a really good history of increasing their dividends. Chorus Aviation, not so lucky. They provide regional aviation solutions. Their main partner is Air Canada, and unfortunately, with the travel restrictions, the stock tanked and they had to suspend the dividend altogether. Chemtrade Logistics sells industrial chemicals. I was attracted to them a few years ago because of their long history of paying out a great monthly dividend of 10 cents a share for over 10 years. Unfortunately, they cut it in half because of COVID recently. So it turns out that the chemicals they sell mostly serve the paper and oil and gas industry, both of which were ruined because of COVID. But hey, just under 5.5% dividend that I'm getting, not bad. The good time to actually buy some more shares would actually be now, but I'm still on the fence of getting more. Invest, another huge disappointment for me, as they suspended their dividend completely because of COVID. They actually own senior healthcare real estate, and not to sound mean or grim, COVID literally killed off a lot of their business. If and when they will reinstate the dividend is anybody's guess. I'll just have to wait it out. And last but not least is one I really like. These guys own the Royal LePage real estate broker brand, as well as two others. So this is Bridgemark Real Estate Services. It's basically a real estate broker franchise business. So they collect royalties from the real estate brokers and distribute them to us, the shareholders. So a really nice dividend. And I was really lucky enough to buy more shares a few months ago when the stock price was down. That's why I have a nice dividend yield of almost 11%. It's been doing really well in the last few months because residential property sales in Canada came back very strong once the COVID restrictions were lifted. So this one is definitely fun to own because you're getting a piece of those huge commissions those real estate brokers get when they make a sale. So why get mad or jealous when you could just get a piece of it too? So that's it, guys. That is a full overview of my entire dividend portfolio. I'll probably post another update early next year so you can follow the progress and hopefully learn from my mistakes and get inspired to start or continue investing yourself. Like I mentioned earlier, I'm gravitating away from individual stocks and more towards ETFs and funds, as they are simply safer and much less at risk for dividend cuts and reductions when things go bad, especially the ones that use a covered call strategy. So investing for passive income is really not hard, guys. Anybody could do it. You just need to stay disciplined and stay the course. The key is really to keep investing regularly. The stocks will do all the work for you. You could download the entire portfolio for free, like I mentioned. I strongly suggest you do your own research if ever you're interested in investing in any of the stocks that I own. Trust me, it's well worth the time. So I really appreciate you guys for tuning in and staying until the end. Please hit that like button. I would really appreciate it as well. And if you're not subscribed, make sure you subscribe not to miss out on all my future content, as well as following us on Instagram. So my mission is to help you guys make passive income to achieve the ultimate goal of financial independence or financial freedom. There's nothing sweeter than that. So don't forget, guys, if you don't find a way to make money while you sleep, you will have to work until you die. So with that, take care and see you next time.